All right, now we're going to talk about liabilities. And we learned about liabilities in the first week when we learned about the accounting equation. So liabilities are the debts of the company, the things that the company owes. And we then learned about the classified balance sheet, and we learned that liabilities are classified as current or long-term. So current liabilities are the liabilities that are due within a year. Long-term liabilities are due after a year. And so we're going to talk a little bit about long-term liabilities just so that we're familiar with what they are. But the chapter in our textbook is on current liabilities, and so we're going to spend more time on the current liabilities. So here are some examples of long-term liability. So a long-term notes payable, a notes payable that has a term of more than a year. A mortgage payable, right? A mortgage on a building, 15 or 30-year mortgages are common, or bonds payable. Okay. So a long-term note payable, usually we will pay it in installments, and actually same with a mortgage. And so the amount that's due within a year is going to be the current portion of the note payable, and that'll be shown as a current liability on the balance sheet, and then the rest of the principal of the loan is going to be shown under long-term liability. So you can have a notes payable shown in both places, right? You break out the portion, the installment that you're going to pay within a year, and then everything else is long-term. So let's say we signed a $60,000 note payable for a loan. The note will be paid over 6 years. We'll be making payments of $10,000 at each yearly installment, and then there's 10% due. And so when we sign this note, right, we're going to have $10,000 is going to be the current portion because that's the amount that's going to be due in 1 year. And so that'll be shown as current liabilities on the balance sheet, and under long-term liabilities, we'll show the $50,000 balance of the notes payable. So this would be the journal entry we'd make when we issued the note: debit cash, credit note payable. And as I said, that $60,000 note payable is going to be split between $10,000 that's going to be shown under current, $50,000 shown under long-term. All right, at the end of the first year, we got to make the first $10,000 installment, and we have to pay 10% interest on the outstanding balance of $60,000. So this is how we'll compute the interest. We'll take $60,000 times 10%, and that'll give us a $6,000 interest expense for 1 year. So the payment we're going to have to make at the end of 1 year is a $10,000 installment plus $6,000 in interest. Debit notes payable $10,000, debit interest expense $6,000, credit cash $16,000. And so now the balance in the note payable is going to be brought down to $50,000 after we make that $10,000 installment. And again, we're going to have to make $10,000 payment in a year, so that's going to be a current liability. And now the long-term liability is going to be $40,000. That's how we'll break down that $50,000 balance. We get to the end of the second year. We got to pay the other $10,000, or the next $10,000 installment. We also have to pay interest on our outstanding balance of $50,000. So $50,000 times 10%. So we'll pay interest expense of $5,000 along with the $10,000 that we're debiting the notes payable for because we're paying off part of the principal. So we're going to pay $15,000 at the end of year 2. This will make our balance now $40,000. $10,000 is the current portion of the note payable, and then the other $30,000 is the long-term liability from this note. And so this will continue for the third, fourth, fifth, and sixth installments until we've paid off the whole $60,000 balance. So a mortgage payable, similar to a note payable, but it's secured by a specific asset. So if we don't pay the mortgage on our building, then the bank can foreclose and take our building. Okay. And so again, the current portion of the mortgage payable is the payment that's due within a year. Typically, mortgages we pay monthly. So the next 12 mortgage payments, the principal portion of those payments, is going to be considered a current liability, and then the rest will be a long-term liability. Then another common long-term liability is a bond payable. So when we need to raise capital for our business, okay, we had been talking about issuing stock. Another way is by raising money by selling bonds. And so when we issue these bonds, okay, the entities that buy the bonds really become creditors. The bondholders are creditors of our corporation. Okay. Stockholders become owners. Bondholders become creditors. And so the reason why a bond, somebody would buy bonds, is that they earn interest. And so the bond certificate is going to show the rate of interest that we are paying and when the interest payments are due. It's pretty common for interest to be paid semi-annually every 6 months. And so when we issue the bonds, the corporation sets the interest rate. And we're saying this is going to be a long-term liability, so maybe it's a 5-year bond, a 10-year bond, right? The interest rate changes as things happen in the economy, okay? And so we can see that as the interest rate changes, right, if the market rate of interest is less than what we're paying in interest, then we have to lower the price of our bonds or no one's going to buy the bonds. I'm saying that backwards. If the market rate of interest is less than what we're paying, right, if our bond rate is higher, we can charge more because we're paying a better rate of interest. If our rate is less than the market rate of interest, that's when we have to change our price of the bonds, because if we're paying less interest than they can get elsewhere in the market, no one would buy our bonds unless we issue our bonds at a discount. So the price of our bonds is going to fluctuate as the market rate of interest fluctuates. So that's why people can sell bonds the way they sell stocks, right? You can have a capital gain because the price of the bonds is going to be fluctuating. So here's an example, long-term liabilities. We're showing the notes, the mortgage, the bonds, the total long-term liabilities. All right. So now we want to talk about current liabilities, the ones that are going to be due within a year. And so some examples: accounts payable, wages payable, interest payable, unearned revenue, right? We talked about back in chapter 2 when a customer pays in advance for goods or services, we have unearned revenue. And so here we can see our current liabilities section. So one liability that we actually have not talked about yet is sales tax. And so if you collect sales tax from your customers, right, when you make a sale, that sales tax money that you collect is not yours. You have to pay it over to the government. So at the time we collect that sales tax, we're going to put it in a liability account called sales tax payable, because as soon as we get it, we owe it to the government. It's never going to be ours. We're just the middleman collecting it. Oh, so let's take a look at if there was a sale on account and there's 9% sales tax. The way we would record that: we would debit accounts receivable for $109, the $100 that the customer owes us, plus the $9 of sales tax. 100 times 9% is 9 that we're collecting and we're going to be paying over to the government. We'll credit sales tax payable for the $9 that we owe to the government, and then sales revenue for the $100 that we've earned. And then at a certain point in time, we're going to send in the money that we've collected from our customers in sales tax. We're going to send that in to the government. And so we record that just like any time we're paying off a liability. We debit the liability. In this case, we debit sales tax payable and we credit cash. Another Current liability is income tax payable. As we earn net income, we are incurring income tax. Okay? We pay our income tax quarterly, okay? But every month when we're doing our monthly financials, we'll need to record the income tax that we have incurred. So we'll debit income tax expense, we'll credit income tax payable. And then when it comes time to make our quarterly income tax payment, we'll just debit income tax payable, we'll credit cash. And I think we'll look at short-term notes payable in our next video.